Hello and welcome to this educational session on the draft ESRS E1 Climate Change presented by EFRAG to provide details of the requirements in the standard. My name is Eric Duvaud. I'm member of the EFRAG Sustainability Reporting TEG. The presentation will be divided in two parts. First, the objective and overview, and then a deep dive on disclosure requirements. So under the climate change standard, undertakings shall disclose how they intend to transition towards a sustainable low carbon economy, which basically means reducing their greenhouse gas emissions and adapting their strategy and business models to become more resilient to climate change risks. E1 covers climate change mitigation and adaptation, as well as the energy topic. Just as a reminder, that the requirements of this and the other topical standards should be read in the context of ESRS 1 general requirements and ESRS 2 general disclosures. That means that the topical standards do not stand alone, but should be understood against the background of ESRS 1 and 2. And E1 is indeed structured around the ESRS 2 governance and strategy pillars, and then it covers the management of the impact, risk and opportunities, and finally the targets and metrics. The colored labels highlight the consistency with the CSRD, SFDR and taxonomy regulations, as well as with the ISSB and SEC proposed standards. Governance of climate-related impact, risk and opportunities shall be described under ESRS 2, and E1 only adds the requirement to disclose whether the undertaking has developed a remuneration incentive scheme based on the achievement of the greenhouse gas emission reduction target. Regarding the strategy pillar, E1 requires to disclose whether and how the undertaking has defined a transition plan, including the greenhouse gas emission reduction targets, benchmarked with a 1.5 degree scenario. E1 requires as well to describe the resilience analysis of its strategy and business model, and finally to explain how it has assessed the climate-related impact, risk and opportunities. Then the management of these impact, risk and opportunities section requires to disclose any climate-related policies, action plans, and related resources, including how these resources are consistent with the green CapEx and OpEx disclosed under the EU taxonomy. Finally, performance metrics then address the energy consumption and energy mix, greenhouse gas emissions, removals and carbon credits, financial disclosures, as or like any internal carbon pricing scheme, and the potential financial effects from physical and transition risk and opportunities. That was for the overview. Let's dive in on the disclosure requirements themselves. Starting with the transition plan for climate change mitigation. The undertakings are required to explain the transition plan towards a low carbon economy they may have developed by detailing some strategic following elements. First one, their emission reduction targets benchmarked with a 1.5 degree scenario. Then the decarbonization levers and the related financing they rely on to achieve these targets. Third, their current and planned green revenues and CapEx and green CapEx as per the EU taxonomy. Whether they are aligned with the EU Paris aligned benchmark, which is defined by limited fossil energy activities. And finally, how they adapt their business model and strategy in securing ongoing access to finance at an affordable cost of capital, in the redeployment, upgrading, or decommissioning of existing assets, in shifting its products and services portfolio, and in reskilling its workforce. Then on conceptual approach, the cornerstone of E1 is the assessment of the climate-related material impacts, risks, and opportunities. Impacts obviously refer directly to the greenhouse gas emissions calculation, and we will come back to this later. Gross material risk and opportunities result from the physical hazards, like sea level rise, and transition events, like a new carbon tax in some countries, under certain climate scenarios that will be factored with the locations of the assets or of the countries of the strategic suppliers. These gross risks should then be translated into potential financial effects expressed in monetary amounts. The transition plan, i.e. the actions and resources to mitigate these risks, are then leading to the resilience analysis, which reflects the remaining net risks for the undertaking. Undertakings shall disclose whether and how they have set greenhouse gas emission reduction targets. As mentioned previously, scenario analysis is key to identifying the impact, risk, and opportunities, analyzing undertakings resilience, setting greenhouse gas emission reduction targets, and assessing potential financial effects from physical and transition risk. The undertaking shall explain whether and how it has identified climate-related hazards and events over the short, medium, and long term, and how it has assessed the extent to which its assets and business activities may be exposed, taking into consideration the undertaking's locations and supply chains. The identification of climate-related hazards and events and the assessment of its exposure and sensitivity being informed by high-emission climate scenarios for the physical risks and by low-emission scenarios for the transition risks. Let's move to metrics and targets. Undertakings shall disclose whether and how they have set greenhouse gas emission reduction targets. This scheme is an illustration of how a reduction target could be presented. Expected decarbonization levels like energy efficiency or electrification or use of renewables, and their overall quantitative contributions to achieve the targets shall be described. Removals and carbon credits shall be excluded as means for achieving these reduction targets. Targets shall be disclosed in absolute value and, if deemed meaningful, in intensity value, like for instance when including Scope 3 emissions. Targets shall also be disclosed at least for the target year 2030 and for every 5 years period thereafter. It is compared the target should be compared to a recent base year, but past achievements may be disclosed to put in perspective the current target value. This one shall be benchmarked. The target shall be benchmarked with a 1.5 degree reference target value. Which scopes and perimeter are covered needs to be transparent as well. On the energy consumption shall be disclosed, broken down between non-renewable and renewable sources, and the energy intensity per revenue is also required to meet the SFDR requirements. It's for the data infrastructure for sustainable finance. Let's move to the greenhouse gas emissions. The greenhouse gas emissions shall be disclosed for scope 1, 2, and 3, according to the greenhouse gas protocol. The intensity per revenue, the greenhouse gas emission intensity per revenue is also required to meet, once again, the SFDR requirements. The share of scope 1 covered by regulated emission trading schemes is required as well, as both location and market-based for scope 2 greenhouse gas emissions. The reporting boundaries are defined as 100% of the greenhouse gas emissions from the financially controlled entities, plus 0 or 100% of the emissions for the non-financially controlled entities and the joint operations of the undertaking. And this decision between 0 and 100% should be made on the basis of the operational control criteria as defined in the greenhouse gas protocol. On scope 3, the methodology for assessing the scope 3 emissions follows the greenhouse gas protocol. So it starts with the screening of the 15 scope 3 categories, 15 scope 3 categories of the greenhouse gas protocol, and then calculation or estimate for the significant categories. The undertaking shall list the scope 3 categories excluded from the inventory, should update or have the possibility to update this inventory each 3 years, and shall disclose the percentage of primary data used. The purpose of the scope 3 disclosure is to show what are the major sources of greenhouse gas emissions in the value chain, basically. The last part of the presentation relates to the potential financial effects from material, physical, and transition risk. So the connectivity between financial and sustainability statements is key in this standard. Climate-related financial disclosures from the financial statements are required to be disclosed under ESRS 2, and E1 focuses on is focused on the disclosure of the potential financial effects from physical and transition risk and related opportunities beyond what is already accounted for in the financial statements. These gross risks and opportunities may generate potential financial effects on future financial position and performance, so the balance sheet and the P&L. We are requiring pre-accounting information based on future events. I would say less likely than not events, I would say. So items to be disclosed include the amount and the list of current net assets at physical risk, the amount of current net assets at transition risk that are usually called stranded assets, as well as the real estate assets by energy efficiency classes, the potential liabilities from emission trading schemes and from contractual commitments to purchase carbon credits in the future. And finally, the share of revenues from activities exposed to physical and to transition risks. And finally, the share of these potential financial effects covered by mitigation action plans is also required to understand the net risks. This concludes this educational session on draft ESRS E1 climate change, and I hope you found it informative and useful. Be sure to also view other videos in this series. For your colleagues and other interested stakeholders who want a short introduction to the standard, please refer them to our suite of videos called Glimpses into ESRS, which is available for each draft standard. Have a good reading and a good implementation. Thank you.